For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Thank you very much. Thank you for the rousing introduction right there. Johnny Dean, your podcast host. We're managing your financial future once again this week. I thank everybody for joining us. Got a lot of new listeners this year. I took a look at the stats. First, let me say hi to Professor Rick Plum, Certified Financial Planner Professional. Hello.
Hello.
Should I ask how your voice is this week? Now, last week, it's a little better now. Maybe. We'll see.
We'll see if I make it.
Coughing
does that to us.
Yeah, it really does. I took a look at our stats here just early on in the year, and we got quite a few new subscribers over the last 2.5 weeks. So I appreciate.
Wow, cool.
Yeah, so I appreciate that, and I just want to say welcome to anybody who is new to listening to this podcast. And I should also point out that when we talk about things with you, Professor Rick Plum, and some other advisors occasionally, one thing that we don't do is we don't talk about things like individual stocks. We don't say buy this stock, sell that stock. Here's the formula you need to understand. We talk mainly about strategy, and specifically the bucket strategy, although we don't cover the bucket strategy every week, but I think it's kind of in the background, when we talk about...
Well, it's all part of how we go about investing. But yeah, you're right. The fact that you can listen to this podcast all different times, you don't have to listen to it the day it comes out. Plus, we may have recorded it a couple days or so before. How can we sit there and say, buy this now, buy this or sell this now? By the time you're listening to it, it could be the wrong time to do what was supposed to have been done 2 weeks before. So we don't do any stock picking. We just talk strategy, things that you can use regardless of what time of the day it is.
Yes, and it's fruitless anyway. Even if you're listening to something live and they say, buy this stock now, whoever's telling you that doesn't know. And it's a fool's game, because when we talk about things like stocks and we talk about things, when we mention equities, these are long-term plays. In other words, long-term meaning 15 years. Some people look at long-term and say, that's, 4 months? No. We go as long as 15 years, 12 to 15 years, something like that. So anyway, just if you want to email us, you can certainly do so. Go to our website, luciacap.com, LUCIACAP.com. And make sure you subscribe to this particular podcast if you haven't done so already. Apple Podcasts and Spotify are the two most popular places, I should say, to get this particular podcast and have it downloaded every single week to your device. We do new episodes every single week, and take a break after about 12 episodes. We kind of divide this into seasons, and then we're back with new episodes right after that. So just some quick housekeeping here at the top of the program. We talked last week, and I hope you happen to hear that, because that got some nice discussion going as well. We talked last week about the taxation of Social Security benefits. Now, we had some people kind of chiming in as to, the taxability and is it going to go away and all that stuff. I'm not going to get into that. But one of the things that came out of that particular discussion, or things that we brought up in that discussion, talked about where you are in the tax bracket. One of the strategies for potentially lowering the taxation on your Social Security, Professor Plum, was to, let's say, maybe do some Roth conversions, and you should do so with the advice of your financial advisor. But doing some Roth conversions and getting money out of your pre-tax accounts like your IRAs and paying taxes on them well before you're required to do so at age 73 or 75. And the thing that you mentioned, Professor Plum, was using the tax bracket, or using up the tax bracket. Now, these are terms that are thrown around a lot in financial circles, and we do mention that quite a bit on this podcast. But I wanted to take this episode and talk a little bit about not just understanding how tax brackets work, but understanding the how they can be best used and how you can actually use them to your advantage. So, Professor Plum, let's start off by talking about how these tax brackets work. And I know that some people believe that if you're in the 22% bracket or you're in the 24, whatever bracket you happen to be in, that every single penny of your income, of your taxable income, is taxed at that rate. In other words, I'm in the 24% bracket, so every single dollar that I make, I only get to keep 76 cents or whatever. We hear that a lot. Can you debunk that right off first so that we can have this discussion, Professor Plum?
I can tell them it's wrong. We have a progressive tax system, and we get to pay a larger tax on the latest income on the return. The first amounts of income on the return get offset by your standard deduction or your itemized deduction. And you don't pay any tax on a certain amount of money that you have on your tax return. And so there's a difference between what they call the adjusted gross income and the taxable income. And that difference is your deductions, your standard deduction or your itemized deductions. So when we look at adjusted gross income, that's basically all the taxable income that we have to our name. All our pensions, our taxable Social Security, our taxable IRA distributions, interest, taxable interest, dividends, capital gains, they all go into your adjusted gross income. But then you get to reduce that adjusted gross income by the amount equal to your deductions, your standard deduction that most people get, or your itemized deductions if you have a lot of itemized deductions over and above just the $10,000 in state and local income tax that is currently being limited. That may go away too. They've talked about getting rid of that. Or at least increasing it to $20,000. That would be nice from a tax standpoint. But if you're looking at your tax return, you want to know where you are on the bracket. You look for the line. It happens to be line 15 for 2024. And it says this is your taxable income. Now you know where you're at. So you can say my taxable income is $100,000. I'm just making this up. But that doesn't mean, and when you look at the tax forms, for 2024, the taxable income of $100,000 puts you in that 22% tax bracket. But as John said, you're not paying 22% on all $100,000 of that taxable income. You're actually paying 10% on the first $22,200 or $23,200 of that. And then the difference between that and $94,300, you're paying 12% on. So for the first $94,000, you're paying just under 12%. It's only that last $6,000 of that gross income or that taxable income that you're paying the 22% on. And so you're paying quite a bit less than just that 22% overall. And the reality is if your taxable income is 100, married couple, that means your gross income was 130. And that didn't even include all of your Social Security. It only included up to 85% of it. So your overall household income may have been $140,000. You're paying tax on 100, and overall you're paying about $10,000 or $11,000 in tax. And so that comes up with your average, or what they call your effective rate. Yeah. And that's about 8% on the 140. But the marginal, if you were to then to look at it and say, well, I want to do a conversion, or I want to accelerate some capital gain, I want to add more income, or I have the option of doing something where I can sell it today or whatever and add more income into my tax return, I'm not paying the tax at the average bracket. I'm paying it at the marginal on that last bunch of income that I'm doing, the conversion of things. So I would be, in that example, in the 22% bracket going forward. Yeah. Assuming that a chunk of that gain or a chunk of the income isn't all capital gain, assuming that my Social Security is already taxable at the 85% level. There's a bunch of things going on here. So this is where it gets dadgummed impossible and just complicated. Well, it's complicated.
And I'm trying to keep this as simple as possible. But, okay, so when you talked about the first chunk of money being taxed at, what did you say, 10%?
Yes.
And then the next being a much larger chunk of that $100,000 being taxed at 12%, going up to $94,000. You're paying on average closer to 12% overall, I guess. On that $94,000. But you did say something. You said, well, if your taxable income is $100,000, that means that your real income was closer to $130,000 or $140,000. And I want to focus on that for just a moment. Now that you've established how tax brackets work, the first X amount is taxed at 10% or whatever. The next X is taxed at 12%. So on average,
once we get to the taxable income, every one of those taxable income dollars has a bracket associated with it.
Yes.
But taxable income is not the first line.
No.
It's later. You've got other things going on ahead of it.
Yeah, and this is where the important part in understanding, and this is when we talked, I guess it was last week, when we said there's a 0% bracket, but there isn't a 0% bracket. Professor Plum, when we talk about the first amount of money that is considered, it actually is taxed at a 0%. You're allowed a certain amount of money. Every taxpayer is allowed a certain amount of money that is not taxed. And this is what is known as the standard deduction.
Correct. And for a married couple, now, since this is coming out about the time people are doing the 2024 tax return, we'll talk about the 2024 standard deduction, which was $29,200. So the first $29,200 of your adjusted gross income doesn't get taxed at all. Zero, not a zilch. Now, there is no true zero bracket, but there is a portion of your adjusted gross income that you don't pay any tax on because you get to deduct away from it. So it's not a 0% bracket. It's just a no tax bracket.
It's not counted on your tax return. You get to take that.
It's not part of the taxable income.
You get to take that off the top before they start considering how much money and where your taxation follows. Now, you said, what is it for 2024? $29,000 per person?
$29,200. No, for a married couple.
Okay, there you go. I want to make sure that that's clear. So for a married couple, it's $29,200 for
a single individual. It's $14,600, half that number.
Okay, yeah. So they've cut it in half, which is good. At least that part is fair. The first almost $30,000 that a married couple makes of income is not taxed at all. Now, there are ways, and this is kind of what I wanted you to talk about from a strategy standpoint, and that's why I said we talk about strategy. There are ways to use these brackets efficiently. Now, I'm sure you've seen people who have come in, Professor Plum, who are in the 0% tax bracket. I'm going to say the 0% tax bracket as if it exists, but who are in the 0% tax bracket, who have room left in the 0% tax bracket because maybe they're living off of Roth IRAs or something or whatever it is. They got post-tax money that they're living off of. And
right, or they haven't taken their Social Security yet, and they're living off of distributions from their bank account. Maybe they've got $500,000 in the bank. Okay, it earned 4%, give it or so. It earned $20,000 in interest, but that's the only income they're showing, and they're taking $50,000-$60,000 a year out of it over the next X number of years. They're not going to pay any taxes because even that interest at $20,000 is going to be a married couple gets to take the first $30,000 without paying any taxes. So the reality is they could be taking money out of their IRAs and paying no tax on at least some amount of money. Don't waste good.
Yeah.
Zero, in this case, is good.
In your example, yeah, that's true. In your example, you said they're taking money out of their bank account. They have a CD, or I don't know, something they have that's probably paying them some interest. And in your example, you said, well, let's say that this married couple is getting $20,000 of interest income in this bank account. And that's the money that they're using to live off of, yeah, and it's paying their bills and all that stuff. So, so that $20,000 is less than the, let's call it $30,000 basically standard deduction. They've got $10,000 more that they could be making in this hypothetical example. They've got $10,000 more they could be making and paying no taxes. So what you're suggesting, if I may just sum it up, and you can expand on this, please. What you're saying is that they should, if they have it, find $10,000 of taxable money. I mean, maybe an IRA
well, this is where
somewhere.
you look at a $10,000 IRA distribution or a Roth conversion.
Yes. So find something, if you have it, that is pre-tax, money that's pre-tax, and convert it or take it out of the IRA because, Professor Plum, in this example, you've got room.
Right, and this is in the 0% bracket. And, the standard deduction, we talked about it as being 29, 30,000. It's a little bit more if you're 65 or older. So we get a little bit of room from those areas. But a lot of people just don't have that left. They've used up that zero. And they're in the 10 and the 12% brackets, or even higher. But the idea is to know where you are and see, okay, am I going to be lower in the future? Have I started taking my required minimum distributions? Is there something else coming down the line that's going to affect my tax bracket going forward? And can I use something that I have? So a lot of people are in the 12% bracket, and they look at their returns and they say, well, the combination of we talked about last week, we looked at my Social Security. I'm already paying tax on 85% of my Social Security, and my taxable income is at $44,000. Because of everything that's going on. Mm-hmm. Well, I'm firmly in the middle of the 12% tax bracket. And I've checked, I'm not going to affect my Social Security because my Social Security is relatively low and it's already at the 85% mark. That means I've got $50,000 worth of room in the 12% tax bracket. I should be looking at taking that money out in the 12%, especially if a married couple is doing this, because the survivor, when there is that effect, is not going to have as much room in the 12% bracket. They're not going to have as much room in the taxability of their Social Security. They're going to lose some of their Social Security. It's going to be 85% of it's going to be taxable. They're going to be in a higher tax bracket when there's a survivor issue. So let's take that money out now and convert it to Roth, so that when we do move ourselves, unfortunately, because of a passing or something of that nature, into a higher bracket, the IRA is smaller and the Roth is bigger, and that's a good thing. And we did it in the lowest potential tax bracket going.
Yeah, and I should state the obvious here, but there may be people wondering and say, well, wait a minute now. You just said I have $50,000 of room in the 12% bracket. So I should, let's just say in this example, maybe grab $50,000 out of an IRA and convert that or take it out to just pay tax on it. But isn't that, Professor Plum, doesn't that mean that I'm paying more taxes today than I would have had to pay? I mean, this seems odd to me.
Well, I'm paying 12% today, and it's unlikely, unless my income goes away, my pensions, my Social Security, all the income I've got goes away, I will never be in a lower income tax bracket than what I'm in today with this hypothetical example. But there is the potential I'm going to be in a much higher tax bracket in the future. Also, what happens, and I got a call from somebody today, they've been retired for a number of years, they want to take $150,000 out of their account to help their daughter buy a condo. And we talked about the tax ramifications of that. And in the past, if we would have been able to, it wouldn't have worked in this case, but if we had the ability to take money out earlier for the last couple of years and build it up in a Roth or build it up in a personal account, then we wouldn't have to take $150 from an IRA and get hit by a bunch of different taxes and potentially increased Medicare premiums, all this kind of stuff in the future. They didn't realize that they were going to do this 5 years ago. Mm-hmm. This just happened, and it became, okay, can we do this in a reasonable manner? How do we make this work and not just get killed by taxes? And so if they had that opportunity to take that $50,000 out for the last 3, 4, 5 years, they'd have a much larger Roth IRA that they could access. And how much is the tax on that access to the Roth? Nothing. So it gives flexibility. Even though they're in the same bracket, taking 150 would have pushed them into another bracket, but it's all about trying to figure out what's going on and giving yourself some flexibility for that unknown in the future that, oh my gosh, I need X, but to get 100,000 out of my IRA, I got to take 150 out to be able to pay the taxes. Ouch. That's going to leave a mark.
We talked a few weeks ago on an episode about how nice it is to have Roth money inside of a Roth. If you have a bunch of money in Roth, the more money you have in Roth, certainly from a tax standpoint, the better off you are. But the other side of that is the cost to get the money. The cost to get the money into the Roth. You have to weigh the cost to get it out of the pre-tax world and put it into the post-tax world. And that's one of the things that you need to consider. And you said one of the first things you should ask is, what's my tax bracket going to be in the future as opposed to today? So if your tax bracket is going to be the same or higher in the future, it's probably a good idea.
Pay the tax today.
Yeah, pay the tax today. And I think this is where a lot of people have trouble wrapping their heads around it because
definitely
they want to save money today. Well, you know what? I was going to get a $5,000 refund this year. And now you're telling me that I should use up the tax bracket. Well, heck, that's going to cost me, I'm making it up, $7,000. I mean, why
it's going to cost you that today.
Yeah, it's going to cost me that today. I really don't want to pay taxes today.
Or there's a large contingent of people that's like, I don't care what happens in the future. I don't want to pay it today. They physically get ill thinking about paying more to the IRS today, or Congress, I should say. Even though, yes, we can see in the future there could be a benefit, and there, especially for a survivor issue, and that's where the biggest benefit comes, unfortunately, is when we have survivors. If we have a married couple today, we have a certain set of tax codes, and then we have a survivorship issue, and we get cut in half on our amount of money we can have in the 10, 12, 22% brackets. It's hard because tomorrow isn't here. We'll deal with tomorrow. It's kind of the Scarlett O'Hara thing. Tomorrow, I'll deal with it tomorrow. But today, I do not want to pay taxes. Well, that's your choice. And sometimes it comes back to bite you.
And it can come back to bite you in a really big way. As you said, you don't know what maybe you will need some money and you will need to draw some of that, and you may not have a choice. And of course, once you get to required minimum distribution age, as we alluded to last week, actually we mentioned it last week, once you get to required minimum distribution age, you are forced to take a certain amount of money out. Now, for those who needed the money to live off of, well, you were taking some anyway. But for those who didn't, that's going to be added income that you don't really need, and you're going to have to pay taxes on it, and it can really mess up your entire tax bill. So sometimes, and this is why we say, Professor Plum, that when we talk about taxes, we try to focus on tax management, not tax minimization necessarily over the short run. When you're talking about tax management and understanding how the brackets work, understanding how the 0% and why it's a progressive tax code and how that works, when you talk about that, you're talking mostly about potentially lowering your tax bill over a long period of time, not paying less today and less tomorrow and less next month, and then paying a ton more 5 years from now.
Right, and it can be looked at multi-generational too. I've talked about what would happen, from a tax planning standpoint between a married couple and then a survivor, but it's also what happens to the money when it goes to your kids. Maybe you've got a couple $1 million IRA. You don't want to take the money out necessarily, but it'll affect you 12, even 22% if you take it out today. But if your kids inherit it, they must take it out over 10 years, and maybe they inherit it in their highest earning years in their late 50s, and they're going to pay it at 35%. Mm-hmm. And maybe you live in Nevada or Florida or Texas, one of the tax-free states, but your kids live in California or New York, and not only are they going to pay federal taxes, but they're going to pay state income taxes on it. So the taxation goes way up for them.
That is true. And there are some states that tax Social Security benefits. I should have mentioned that last week. But yes, no, that's something to consider. So while you might be saying, I don't want to pay taxes now, I hate paying taxes, and the heck with this, I'm going to stick it to the man. Hey, more power to you, but this may hurt from a survivor standpoint, is what you're saying, because when your kids inherit it, at that point, they're going to wind up paying
get hit hard.
A much bigger.
With the new rules as far as required minimum distributions for beneficiaries on retirement accounts, they could, now if you've got 15 beneficiaries and you're spreading it around 15 different ways, you may be able to get away with some of that. But if you've only got 1, 2, 3 beneficiaries and they all take it out, and a lot of times people are dying in their 70s and 80s and their kids are in their 40s and 50s, they're still working and they're getting hit hard on the taxation.
This shows the importance of not just understanding how tax brackets work, but understanding what your financial advisor is recommending that you do. I don't know how often you've run into this, Professor Plum, and maybe it doesn't come up a lot, but how often do you get people who say, whoa, wait a minute, you're telling me to pay taxes now, and I don't have to pay taxes now, but you're just making me, I'm not making, but you're suggesting I do it? How often does that come up?
Well, we're in almost any retirement scenario, we're looking at, can we do something to make a better situation either today or in the future. And a lot of times we're taking distributions from IRAs before we get to required minimum distribution age to reduce the IRA in the current tax bracket so that the survivor doesn't have to deal with it somewhere down the line. Also, so we don't have to have a big increase in the required minimum distribution. I mean, some people set themselves up to, they start taking, retire at 65, 66, 67, and they live off their personal money as they read about online, which says that's the best way to do it.
And don't
don't touch your IRA until you're 73 or you're required to take it out, depending on your age. And so they're living pretty much tax-free for the first 4, 5, 6, 7, 8 years of retirement. And then the RMD kicks in, or they run out of personal money, and their only choice to live is to take money over and above, what they get from the Social Security from their IRAs. Now, not only is that IRA distribution taxable, a big chunk of their Social Security is taxable. And it's creating a big stain on that tax return.
Yeah, and because I think what gets people's attention, and it's amazing how many places when I look online, and I just do searches, and they're advising what you just suggested, which was that, hey, you read it online, they're telling you don't pay taxes now. Forget it.
Later.
Put them off. Pay them later. And
the standard distribution strategy from a tax standpoint is live on personal money until you can't do anymore or until the required minimum distributions kick in. And then live on required minimum distributions. Never, ever, ever touch your Roth IRA. That's the last thing you want to do.
That's what they say.
That's a complete misunderstanding and a lack of understanding of how to benefit your tax return.
Yeah, and this goes back again to the idea of tax management. And how is it best, not just for today. I mean, nobody wants to pay a ton of taxes today. But
I hate taxes. I hate paying them. But if I can pay less, over the next 5, 6, 7 years than I would have by going nothing today and a lot more later on, that makes sense to me.
It helps to keep in mind that when you have things like IRAs and 401ks and all these things, that no matter what, somebody is going to pay taxes on that, whether it's you or your beneficiaries, unless you decide to leave, this stuff to a charity of some kind. But let's assume that's not the case, that you've got inheritors, people who will be inheriting this money down the line. Somebody's going to be paying taxes on that money in whatever bracket they're in. And with the new rules, you said this before, with the new rules, people who inherit IRAs cannot stretch it out over their lifetime anymore. It all has to be out within 10 years.
Most cases.
In most cases. But yeah, that's since somebody is...
What you just mentioned also brings up another area, understanding what you are doing with your estate plan and how you're doing it. So I want to make a charitable gift when I die. I want to leave $1 million to X charity. I've seen it where people will leave a piece of property or their personal stock portfolio to the charity, and they still have their kids getting the $1 million IRA. And it's like, wait, let's go the opposite way. Give the charity the IRA and give the kids the property, or gives the kids the stocks, because the kids inherit that without an income tax associated with it, and the charity inherits the IRA without an income tax associated. The other way around, charity gets the money tax-free either way, but if you leave the kids the IRA, they have to pay tax on it. So let's be efficient with how we're leaving things. Yes, I mean, not everybody's the same. We're all going to have different goals for distribution at our passing, but let's make it as positive as possible for everybody involved, except for the IRS.
And that's the thing. You might think you're sticking it to the man now, but the man is going to come back and get you later on, or your heirs, potentially, if you're not careful and you don't really understand how this works. So I think I said last week that it's always helpful, Professor Plum, for you as a financial advisor to have the other person on the other side of the desk understand what you're doing and why you're doing it, and to be informed of this stuff. Yes, tax brackets can get complicated. We've kept it fairly simple, I hope, today, but it can get complicated. But at least understanding why your advisor is doing it and the potential ramifications of what they're doing are important to understand. And that's kind of why we talked about this today. Professor, if nothing else, I just need people to understand that the first, for a married couple, almost $30,000 is not taxable at all of income. Use that bracket if you can. And whatever bracket you're in, If you have room in it, Professor Plum, I think your advice would be to, if possible, use it if you're not going to be in a lower tax bracket later.
Just trying to be efficient.
That's it. The folks at Lucia Capital Group who sponsor this particular podcast do this kind of stuff all the time. Professor Plum gets really excited when he's talking about this. His face just lights up. And I'm serious. I'm not being sarcastic here. You really do enjoy this stuff because...
It is fun being able to manipulate things in either your favor or the client's favor away from the man, as you call him, the IRS Congress.
Well, it is. It's just, there is by law a minimum amount of tax that everybody has to pay. I mean, sometimes it's zero, but there is a minimum amount that you're required to pay. And it's important to try to get as close to that number as you can. I think in many cases, people pay more, sometimes much more than they need to pay, than they're required to pay. And nobody's going to phone you back and say, hey, you paid too much, here's a check, in most cases.
They're not going to thank you for it either.
No, they're not. So nobody wins with taxes. So this is why we talk about it. Talk to the people at Lucia Capital Group, 800-644-1150, 800-644-1150. Longtime sponsors of this particular program. Have them talk to you. Maybe have them look at your particular situation. If you haven't looked at your tax bracket for a while, or you haven't considered things like maybe doing Roth conversions, not for everybody, but at least take a look at your tax bracket where you are and decide, is it a good thing to do right now? And if it is, maybe pay a little more tax, a little extra in taxes now to avoid a huge tax bill later. These are the kinds of things that your financial advisor should be looking at, and these are the things that the folks at Lucia Capital Group, the advisors at Lucia Capital Group, do every day, and they enjoy it. I was going to do my Maxwell Smart and loving it, but I'm not going to do that.
Not feeling it.
I'm not feeling it, and just not enough people anymore know exactly what it is we're talking about. But
Maxwell Smart.
800
Get smart.
800. What a great show. 800-644-1150 at Lucia Capital Group. Go online as well, luciacap.com, LUCIACAP.com. Find all this information and a whole bunch more, not just in written form. We've got audio pieces, blogs, white papers. Also have videos you can look at. Just a ton of information there at luciacap.com. And again, want to remind you to download this podcast every single week automatically by subscribing to Managing Your Financial Future. You can do so at Apple Podcasts and Spotify. It's a lot easier than trying to find it on our website. Just go and subscribe, and you'll get it downloaded automatically to your device and listen to your heart's content. These are great, great episodes. Haven't had a bad one yet that I know of. If I did, I wouldn't tell you, but I don't think I have. Professor Plum, thank you again. I appreciate it. As always, you got work to do, so we're going to let you get back to that.
Thank you.
But it's nice to have you here, and I hope you folks got something out. If you have any questions, go to luciacap.com, as I said, and you can also find our downloadable Social Security guides, the Bucket Strategy Guide, Retirement Guide, Estate Planning Guide, and a few others. Just type that into the search bar, and it's all yours to download and take a look at it whenever you want, all for free. For Professor Rick Plum, Certified Financial Planner Professional, I am your podcast host, Johnny Dean. Thanks so much for listening. Managing Your Financial Future. We will, as always, talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. There's no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including the potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was as established, whichever is longer. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.